I think the context is extremely important. And as you say, we've been in and still are in one of the deepest recessions in modern history. And most bull markets actually start during recessions as investors start to anticipate a recovery. And that initial recovery from a bear market low tends to be very, very strong and driven by rising valuations. That's really exactly what we saw from March through to October. But we think we're transitioning into a period where profit growth is pretty strong. We've already seen the start of upward revisions to profits estimates. Globally, we're looking at profits rising next year by about 34%, albeit from a very low base. And we've still got the backdrop of extraordinarily accommodative policy, negative real interest rates, expanding fiscal policy, and in our view, no likely rise in policy rates among the central banks until early 2025. So that backdrop is still quite supportive for risk assets.
And looking at the shape of this recovery, if we look back at the 2008-2009 recession and what happened thereafter, it was a slow and grudging recovery. This time round, one of the key differences is that people have been, for the most part, saving up during quarantine. So they've got a buildup of liquid assets here. How much is that going to play into the recovery thesis? And if you could describe for us how you see the shape of the recovery in 2021 from an economic perspective.
Yeah, absolutely. Look, I think, and you mentioned it at the outset, we see this as what we describe as an event-driven bear market. What do we mean by that? Well, we think it was a recession and a bear market triggered by an exogenous shock, albeit a very significant one. And when we look at history, the kinds of recessions that are triggered by external shocks tend to be over, and the bear markets associated with them tend to recover more quickly than average bear markets. Now, if you look at the financial crisis 12 years ago, that was an example of what we call a structural bear market. These are rarer and much more severe. They tend to be reflective of imbalances which build up over many years prior to the collapse, asset price bubbles, and when they burst, that often leads to banking crises or real estate crises. And that's exactly what we saw around the financial crisis. It's similar to what we saw in Japan in the late 1980s and early 1990s, but the hangover effects of that lasted a lot longer. Of course, in this particular situation, the real problem is a forced lockdown of economies to contain the pandemic. But we felt that as those restrictions moderate, you'd see quite a strong V-shaped recovery, both in the economy and the market, bearing in mind also that you're seeing this huge fiscal and monetary support together, which really do reduce the tail risks and the risks of more structural damage to productive capacity during the downturn. And that's, I think, the big difference.